Ladies and gentlemen, we are thrilled to introduce to you Rich Checkan, President and COO of ASI. Mr. Checkan has knowledge of every facet of ASI's operations. He has been an integral part of ASI's maturation from a precious metals and foreign exchange dealer to a full-service tangible and rare tangible asset provider to include rare U.S., world, and ancient coins. He is a regular contributor to ASI's own monthly newsletter Information Line, as well as a regular writer for ASI's twice-weekly news alert, Always Something Interesting. Rich, thanks so much for being here.
Absolutely my pleasure, Chantal. And good afternoon, everybody. Thank you for joining us here today. First off, I just want to say a load of thanks to Chantal, Rena, Debbie, Kim, and Charlie for allowing us to participate and offer some of our knowledge to y'all here today. I commend you for sticking around on a Friday to hear what we have to say. And I think what you're going to understand by the end of this is that, very, very passionate about what we do, believe in what we do immensely, and absolutely believe that we've helped a lot of people over the years. I've been with the firm 25 years. Asset Strategies International is a Rockville, Maryland based corporation. As Chantal said, we're full service tangible asset dealer. And the company's been around since 1982. My uncle and his partner, Glenn Kirsch, founded it in 1982. So we've been helping people for a number of years. And, from the very first day I got here 25 years ago, I've heard, the mix up, the disconnect, the misunderstanding between physical gold and gold shares. What a lot of people think is you have to do one or the other. You believe in owning stocks or you believe in owning physical gold, and you can't mix the two. And hopefully by the end of today's presentation, everybody will understand that nothing could be further from the truth, that all of these gold sector investments, whether it be direct physical gold ownership, exchange traded funds in various precious metals, or mining and resource stocks, or funds of mining and resource stocks, all have a place in a portfolio. And the trick is to make sure you're buying the right investment to meet the goal and objective that you're looking to accomplish. This is not a zero-sum gain. So today we're going to talk about physical gold versus gold shares. What's the difference? First off, I want to start with why everybody's talking about gold. Gold has now broken out. The last bull market in gold, which went from 2001 to September 2011, saw gold reach just over $1,900 an ounce before pulling back all the way to $1,050 per ounce, right about the point where the Indian government had bought gold. I believe it was about 200 metric tons at the time at that price. And when that happened, I remember it in, I want to say it was like 2007, 2008. One of the first articles I wrote said that this is the new floor for gold. This is the end of three-digit gold. So far, I've been right. And I absolutely believe that's going to hold because, the Chinese and the Indians in general are some of the most amenable to gold buying that we've seen throughout history. They're always number one or two in terms of total gold buying activity. And when they were willing to buy gold at $1,050, it told me that that's the end of three-digit gold. That is the floor. And so far, since the last bull market, the bear market bottomed out right there and started moving back up. But a lot of people have a misconception. If you look at the chart, you'll see that despite what people think, gold did not break out this spring. Gold broke out in May of 2019, if you look at the chart. So it went through a long period of consolidation, 3 years of consolidation, testing and failing right around the 1,300, 1,350 mark, and dropping back into the 1,200s and then doing it again, rinse, wash, repeat, or wash, rinse, repeat. So that happened quite a bit. And then it finally broke through with an incredible gusto, got all the way to near $1,500 an ounce before pulling back again. And then it started easing up, and then you see what happened in the spring of this year where gold had another kind of mini breakout. But we were already in an established bull market at that time. That's why people are thinking about gold right now. So why are they turning to gold? Well, safe haven flows. Traditionally, when you look at times of social, geopolitical concern or crisis, people will turn to US dollars, Japanese yen, or gold. These are typically where people put their money when they're concerned about what may happen next, globally, locally, what have you. And part of that uncertainty right now is coming from the volatility in the stock market. And we just saw another example of that here, after the Fed announcement on Wednesday, where Jerome Powell, the Fed chairman of the Federal Open Market Committee, decided to leave interest rates at 0%, probably until 2022 is what they suggested. And he went on to say that there's significant cause for concern in the markets going forward. Those comments triggered what we saw yesterday, which was an $1,800 drop in the Dow. And the last I saw, it was up about 300 here today. So in 2 days, we've dropped about $1,500. Now, part of that as well is basis the fact that there were some additional coronavirus escalation, if you will. I don't know how much of that was due to the fact that we opened back up and now the numbers are climbing. I think it's more due to the fact that there's increased testing. But the combination of the two really rocked the stock market. So that has people concerned. And therefore, there's future uncertainty. We don't know where things are going. We don't know if we're going further down before we move up. After a 10-year unprecedented bull market in stocks, I got to think there's a little bit more downside possibility or potential. So, okay, and for some reason we're going backwards, so we don't want to do that. Okay, so now we're looking at historical gold bull markets, which again, as I mentioned, it started last year, May 2019, we broke out. And if you look back historically, and you can really only go back the past two bull markets. So you saw one from the early 70s to 1980, and you saw another one from 2001 to 2011. They tend to be long term, so 5 to 10 years these things last once they get going. There's no guarantee that will continue into the future, but they tend to be long lived. Second, they tend to be significant. So let's just look at the last bull market, the one before it was virtually the same. Gold went from $253 an ounce in 2001 up to $1,900 in 2011. That's about a 650% appreciation. Silver went from $4.51 in 2001 to nearly $50 an ounce in 2011. That was in April. So that's 1,000% appreciation. Now, you can't guarantee that's going to happen in the future, but it has held up for two bull markets since we came off of gold as an official price, since gold and the dollar were no longer convertible. That's why people are looking to gold right now. So that begs the question, why do you own gold? Well, again, if gold tends to come up in crisis times or times of crises, then it must have something to do with protecting you against crisis. And, most people commonly look at gold as wealth insurance, and I define it as such. Gold is a store of purchasing power in a form with high liquidity for a potential financial crisis you hope to never have. That is what gold should primarily do for your portfolio. It stores purchasing power. It buys the same amount of goods and services as it did 1,000 years ago. Now, the dollar price is different because the dollar's weakening over time. But gold buys the same amount of goods and services as it always did. And it is there for you when you have a financial crisis. If you have one, you immediately sell it. Don't hesitate. That's what it's there for. You meet your financial crisis, and then as quickly as possible over time, you replenish your wealth insurance. But when you need it, you don't hesitate. So how do you own gold? Common ways: direct physical ownership. You buy it, we send it to you, you hold it in your hands, you store it yourself. Another option is third-party storage. So you buy it, we send it to either you and you put it in storage, or we send it directly to a storage account in your name, and a third party who does that for a living watches your gold. They're the custodians of your asset. Exchange traded funds, or ETFs, mining stocks and funds of mining stocks. Now, I will point out that the first two, direct physical ownership and third-party storage, are the only two that allow you to own gold. With exchange traded funds and mining stocks and funds, you own no gold. Doesn't mean that they're bad. They have to be bought and used for the right reason. But only direct physical ownership, either by you or stored at a third party, is a situation where you actually own gold. Direct ownership. There's no counterparty risk. You own it. Gold is what it is, okay? It's the only asset that is not simultaneously someone's asset and someone else's liability. 2, immediate access. If you need it for that financial crisis, it's right there. You put your hands on it and you meet the need. Direct correlation to the gold price. It is gold. What gold is what it's worth. That's it. I can't make it any simpler. There's no mathematics, no equations, no conversions. Whatever the gold price is, that's what it's worth any point in time during the day, and it trades regularly. You do need to safeguard it and secure it, whether that be yourself or through a professional third party. You have to make arrangements for it because it's an untraceable asset. It's dense wealth, and if you lose track of it, there's no getting it back. It's not like it's marked with your name on it. There's no chip, in its head. You got to take care of it. And as a result, if you pay somebody to safeguard and secure it, you have potential ongoing costs. A lot of people look at that as kind of like rent or a rental fee in owning gold, because they have to pay to secure it properly. Let's look at exchange traded funds, ETFs. Again, no gold ownership. And I know you're saying, well, wait a second, I'm buying a 10th ounce of gold if I buy GLD. No, you're not. What you're doing is you're buying shares in the trust that owns gold to track the gold price. All right. As a result, there's multiple counterparty risk. You have a trust that's responsible to you. They have to buy metal from or borrow metal, or buy metal, a share in the metal from some sort of provider that has to be stored somewhere else. So there's a lot of different hands in this pot. There's limited insurance. You don't have 100% insurance of the metal at full market value at all times. And if it did go missing, who gets paid and who doesn't get paid is very, very murky water. Again, you don't have claim to the gold, you have claim to the shares of the trust. So in many cases, you may have no recourse as an investor, depending on what happened. Now, here's the one that always gets me. I know it's easy to buy an exchange traded fund, and if you believe that means you're owning gold, that's wonderful. But the reality is you're not owning gold. So why would they need to track the gold price if you were owning gold? Well, it's because you're not owning gold, you're owning shares in the trust. Nobody virtually ever asks me why, even though gold share is supposed to be, in an ETF is supposed to be 1/10 of an ounce of gold, why it is rarely, if ever, 1/10 of an ounce of gold. Nobody ever asks me for silver in an ETF, which is supposed to be a share is supposed to be 10 times the price of silver. Nobody ever asks me when they look at the price why it's virtually never 10 times the price of an ounce of silver. And the realization is it only tracks the gold price. It only tracks the silver price. There is a fund manager, because a fund manager has something to do here. They have to marry up the buys and sells of the shares of the ETF from the general public with physical purchases or physical sales. So if, say, 50 ounce, everybody buys gold all day long, and at the end of the day, they need to buy 50 ounces of gold, that's wonderful. except for the fact that the ETF is constrained where they must buy or sell in minimum increments of 100 ounces. For silver, 10,000 ounces minimum increments. So if at the end of the day, the ETF manager needs to buy 50 ounces of gold, they have a decision to make based on where they think the market is going next. Do they buy 100 ounces and go long 50 ounces to fill their 50-ounce need? Or do they stand pat, stay short 50 ounces basis where they think gold is going tomorrow? Okay, same thing with silver. If they had to buy 5,000 ounces, they can't. So they have to either buy 10,000, go long half of it, or stand pat and be short what the clients have asked for. It only tracks the gold price. There's other management fees and costs, et cetera, that get tacked in there. So it's never going to be, or virtually never going to be exactly the, 10 times the silver price or 1/10 the gold price. And a lot of people don't even ask that question, let alone understand why. But the manager has a role to play. And another common misconception is even though it's considered a stock or a fund, it is a proxy for gold, and therefore it is taxed at a collectibles rate. So you make sure you're working with your tax attorney and your accountants when you go ahead and handle the taxes on your buys and sells here, because they are taxed as if you were owning physical gold. Moving on, look at mining shares and mining stocks. And I remember 25 years ago, I would get questions from people. I'd call up and I'd say, okay, I know you want to buy gold. You say you want to own 5%, say, of your investable assets in gold. Do you have any gold at all? And they say, yes. I said, great. What are you holding? Is it gold Eagles, Maples, Philharmonics? What's the case? And they say, well, I own Newmont Mining. Okay. And then I told them they own zero gold. It's not a bad thing to own Newmont Mining or any other mining stock, but you own no gold. Understand that. Why? Because there's other variables that affect what your profit is. It is tied to the gold market. The gold price, whether it's moving up or down, or whether we're in a bull or bear market, has an impact on the profitability of this company. But it does not offer you any gold ownership. What you're owning is shares in a company whose business it is to mine gold profitably and hopefully return those profits to their shareholders. And there's a lot of variables in a company other than just holding an ounce of gold in your hand with no asset or liability for someone else. There's a lot of variables in a company that can affect that price. First off, management. Is the management team good? Are they bad? And they all have track records in most cases. If they don't, you might want to consider standing on the sidelines till they have a track record. But management plays a role in the profitability of the company. The environment. So, and I'll give you an example here in a second of how that impacted a certain venture. But there are all sorts of environmental risks and concerns in any area where they do mining, and they have to meet all those requirements in order to be able to open the mine. Costs money, costs time. Indigenous personnel, how are they treating the people in the locality where they're mining that could cause all sorts of issues, either one-off or for the life of the mine. Investment in the company. And that could take several forms. So if they make some profits, they might want to take care of their employees, keep them happy and have them working hard for them. So they might want to increase their salaries, whether it be for employees or management. They may need to buy some equipment. They may need to reinforce infrastructure. They may need a grinding mill. They may need to increase the electricity or the power to the place. They may need to put in better roads, etc. They may need to do more exploration on the site to find out where they dig next. And all these things cost money. Now, there's incredible potential for leveraged returns with mining stocks, okay? But again, it's no gold ownership. Okay, so you just have to understand that this comes out, ETFs come out of an equities allocation, not out of your gold allocation. Now, give you one quick example. Chief Mines, Consolidated Mines. We owned it. Very good mine, proven track record, proven management, proven reserves. They had followed Newmont Mining's lead prior to the last bull market, and they had stopped all their forward selling. They were ready to participate in that bull market. The bull market took off and their stock price went through the floor because their mind flooded and they had environmental concerns, and they do to this day. Okay, so they had done everything right. Their company was poised for success. A flood killed them. An environmental issue killed them. Again, no gold ownership, potential to benefit in the sector, but no gold ownership. This is a mining stock. This is an equities allocation. So what's right for you? Well, you have to look at your goals and your objectives, and then I would strongly suggest that you consult with experts. Because as I said at the fore, this is not a zero-sum game. If you want to own gold, from my presentation here, there's only two ways to own it. You can either buy it and have it shipped to you, or you can buy it and have someone hold it on your behalf. But that does not mean that you shouldn't have ETFs in your portfolio. It does not mean you shouldn't have mining stocks and funds in your portfolio. Again, if things are poised for a run, we're entering into a bull market, I would expect people to be buying mining shares here and funds here because there's the potential to get that leveraged return. Comes out of an equities allocation. I've used gold in my portfolio. I've used mining stocks and funds in my portfolio. I've used ETFs. Now, I choose to use ETFs a different way because I think there's a better way to own gold by actually owning it. So when I use an ETF, what I tend to do is I would rather be in an ETF for gold or silver than dollars if I exit a position in my equity portfolio and I don't know yet what I want to go into next. That's typically where I'll use an ETF. It's great for funds and institutions to own gold, where you have the economy of scale of moving large amounts of gold, et cetera, around. So that gives them exposure in the sector. So it's geared right for them. But for the individual investor, if you want to own gold, you need to buy gold. You need to have it shipped to you or to an account in your name. But look at why you're buying these things, talk to an expert, and figure out what's right for you, what's the right allocation, does it meet your objectives, okay? We're here to help. There's a PowerPoint on our virtual booth that includes this presentation, so you have all this contact information there, and we stand ready to answer any questions you might have about gold, mining stocks, ETFs. We can only help you on the gold portion, whether it be physical, bullion, or rare coins, domestically or abroad, but we're passionate about what we do. I think everybody ought to own a small piece of gold for wealth insurance all the time. That's without saying. And they ought to consider it for profit at the early stages and throughout a bull market, buying on the dips as it climbs higher. And actually, one last bit before we move to questions, keep an eye on silver here. Silver tends to, they call it the poor man's gold, but it tends to follow gold and then outpace it historically to the upside and to the downside. So silver's been lagging gold for the past year. It started the breakout last May as well and faltered, and it's been lagging behind. And over the past month, it's up about 20%. So it's the sleeping giant of potential in silver to move higher is starting to awaken, and it's playing catch up. A month ago, it took 127 ounces of silver to buy 1 ounce of gold. Today, silver's weakened a little bit as on some profit taking over the past week, but now it only takes about 98, 99 ounces of silver to buy 1 ounce of gold. So it's already playing catch up. These are some of the insights we can work with you and we can help you. And I'm open the floor to any questions.
Hi there. Thank you so much, Rich.
No problem.
Okay. What are your 3 top large cap best gold and silver companies?
That's a good question. That's really not in my bailiwick, to be honest with you. I'm not an equities trader. I'm a physical gold dealer. I may have some preferences, but they're really not based on the type of analysis that you want to get from an asset manager that deals in that for a particular reason. Offline, if you want to send me your information, I know a few. I can make some recommendations who have been with the Money Show over the years. So I know they're vetted and we've known them at least decades. But that's not really my place. I do very much like having a mix though of minors, some juniors for speculation and understand that's what they are. And I love royalty companies to minimize my risk and increase my potential.
Okay, thank you. Now, gold is up 17% thus far this year. Why are people looking to gold right now, and do you see this continuing?
Yeah, so I touched on a little bit in the presentation, but there's uncertainty out there, so people are going to flock toward gold. In the spring, when gold took that second leg up with the catalyst of the coronavirus, we saw initially as the stock market plummeted in March, end of February, beginning of March, we saw gold sell off too. And what was happening there, just so everybody understands, is gold was filling its role. It's really the only liquid asset with a store of value that you could put your hands on to meet margin calls, etc., when your portfolio is bleeding. So a lot of people sell off to tap into that. Additionally, we saw another wave of selling of gold as people were uncertain about the future, not knowing what post-pandemic markets are going to look like, didn't know how long they may be out of work, etc., and what the new normal might be. So we saw other people tapping into their gold to sell off and hold some cash for an uncertain future. Since then, we've seen the buying opportunity kick in. People have come in to take advantage of cheaper gold prices because they should not be, and they've been moving up fairly steadily with consolidation periods along the way. We love buying on the dips in a bull market and suggest everybody consider doing so if they have a mind to buy some metals. I do see it continuing as long as we measure gold in fiat currency, because it is mismanaged. This stimulus is going to generate all sorts of inflation. I mean, it's not going to be immediate, and we're not going straight to inflation. I think first we're deflationary as the market starts moving. I think we're already officially in a recession, and then I think the inflationary forces will start. You cannot stop them with the expansion of the money supply that we've seen, and I see eventually us moving into stagflation like we saw in the 70s. And for all those reasons, you want to be owning gold.
All right, and which is the best way to own gold? Physical, ETFs, or mining stocks, and why?
Yes. I love them all. As I said in my presentation, it's not a zero-sum gain. I love the leverage returns you can get with mining stocks. They are absolutely part of my equities allocation. I'm not the expert there. I turn to experts for that guidance. I love precious metals, both for physical metals, bullion, gold coins, and bars, for both the wealth insurance aspect. For me, that's 10% all the time, okay, of my investable assets. And then when we're moving up in a bull market, I look to another 10 to 15% in gold and silver for profit. Primarily there, I weight towards silver because of what I said about the outperformance in most bull markets. So I love that. And then, like I said, ETFs, I use them personally as a holding position. I'd rather be in them than dollars when I don't know where I'm going next. But I use all three, and I suggest everybody has a need for those in their assets in their portfolio, as long as they're buying them for the right reasons to accomplish the right goal.
All right, and what U.S. gold coins do you recommend?
There's two major gold coins, the Eagle and the Buffalo. Both are fantastic. They hold their value very well. They're recognized worldwide. That's what you want out of gold. You want to have something that is liquid, right? So no matter where you go in the world, people will say, "Yep, I get it. That's an ounce of gold. What do you need? Goods, services, etc." I know the value of that. I can trust that. The Eagle and the Buffalo are both wonderful. From preference, beauty, I love the Buffalo. But it's a 24 karat gold coin, so it could get scraped and scuffed and so forth as you store it. Most people tend to go toward the Eagle for the durability, because although it's a 22 karat gold coin patterned after the Krugerrand of the 70s and 80s, it does have a full ounce of gold in it. So if you weighed it, it weighs more than a troy ounce, but there's an ounce of gold there for durability.
Can you tell us how one goes about purchasing gold or silver?
Very simple, and it just starts with a phone call or an email. Reach out to us, reach out to at least a couple other dealers as well. I encourage everybody to shop always, at least 3 people, or 3 dealers, but you just make a quick phone call. It's not rocket science. I go to conferences and people will raise their hands at the beginning when I ask how many people believe they ought to have gold in their portfolio. Every hand goes up. If I follow on and ask how many people do, you'd be surprised how many hands go down. And it's not because they don't believe in it, it's because they don't know how. Fear of the unknown, uncomfortability, whatever the case, they just don't take the step. And really, it's a phone call or an email. You can get a quote right over the phone. We can come to terms right over the phone. You send us funds, we clear funds, we send you metal. It's not hard.
Rich, thanks so much for being with us today.
Oh, it's my pleasure. Thank you for having me.
Of course.